Welcome back. Time to talk numbers and time to talk to one of the managements of corporate India. Very, very strong numbers. We have Parvat Srinivas Reddy, who's the managing director at MTAR Tech, joining us. Mr. Reddy, always great speaking with you. You stand at the confluence of, and this is for viewer perspective, stand at the confluence of aero as well as nuclear. And that's what makes MTAR Tech so very, very interesting. But let me take a step back. Let's talk about Q3, sir, first off. Let me try and understand from you what led to the kind of beat that you've delivered in terms of the Q3 numbers. Because not only have we seen record in terms of top line execution, so that's been very strong, but you've seen a surge in margins at 23%. We've not seen those margins before from you. So talk to us about, I know that there's a bit of products mix shift that's happened. Talk to us about what has played out and what is likely to play out in Q4.
So basically, we have done extremely well in our clean energy segment because of the demand that has been created. Obviously, we had to ramp up to that level, which we did very successfully. The execution was very good, and it will continue to improve further quarter-on-quarter basis. And also, we have been working on a number of growth engines in aerospace and other divisions, nuclear over the years. So the other growth engines are also showing pretty good results right now. And because of the operating leverage and higher revenue numbers, we're able to even achieve the margins that we would like to achieve and even further improve moving forward to the next quarter as well.
Mr. Reddy, you've guided for 900 crore top line in FY26. Very likely because you're currently at 280 in terms of execution. You've done 280 crore this quarter in Q3. It'll mean that you have to do at least another 350 in the next quarter. Likely to happen?
Yeah, absolutely. I mean, we are going to do obviously more than 300 crores, obviously, to achieve the 900 crores plus. That's right, definitely on the track, and we'll be able to do that.
And what next year? You've guided for another 50% growth next year. Obviously, your order book is extremely robust. So what changes for you all of a sudden? Because you seem to have hit a different pedal starting H2 FY26. What has changed?
The three main areas, I mean, I would say the clean energy segment is one area.
Yes.
The aerospace is showing very good results, going to be a very good growth engine for next year as well, in a much bigger way. And then the nuclear is going to take off next year very well. The kind of orders we have received from that division as well. And we're also entering into new segments like oil and gas next year, the second half of the year. So the guidance what we have given is 50% revenue growth rate is on. It's a very reasonable guidance to begin with. And that's something which we'll be able to achieve and also with improved margins as well.
Exactly. That brings me to the margin picture, right? You've guided for 21% margins in FY26, but you had one muted quarter, which is Q2. In terms of your margin number, that was mid-teens, 13% odd in terms of margins. Talk to us about what FY27 will look like, because if top line grows by 50%, which is from 900, you go to 1350-ish, your margins, your operating efficiency should kick in. But outside of that, you're saying that product mix shift is also aiding in the numbers. So what's the kind of steady state margin you're targeting, and what is the FY27 margin we can expect?
So we are expecting, I can't really come to the exact numbers right now, but we are showing we are going to get a very high number, much better margins. Like right now, we're doing 23 for Q3. Obviously, the Q4 margins will be slightly better to average around 21 for this year. So next year, something between 24 to 26%, we might even go up to 26%. We just have to see that. But definitely much, much improved margins for next year.
Is that something that can continue going forward in terms of the 25-26% margin number? Is that sustainable?
Yeah, it is sustainable, and we might do even better moving forward. As and when we go to FY28, it will be even better. Based on the kind of order book and the demand what we're looking at right now, it could even be better the subsequent years.
So in terms of product, Mr. Reddy, explain to us, which of the products do better margins, and therefore I'm trying to sense, because you have a tilt now towards aero and nuclear, are the margins materially better versus the 20% that you've traditionally done?
Yes, definitely, because we have been investing a lot in the first articles, various other developmental activities. What numbers you see, you don't see the actual work being done by the company over the last couple of years, and now you're seeing those numbers kicking in because we have been working on a lot of R&D, developing a lot of products, parts, first articles over the last couple of years. So obviously the margins would be substantial in aerospace and nuclear as well, and that would improve the margins further. The revenues are going to improve in these areas much more. That will aid to the margin improvement. And because of the huge operating leverage in clean energy, it will obviously help us to achieve higher EBITDA margins. So what we're looking at, what I said is about 26 to 24, 26% can be, that's on the conservative side as well. But we'll comfortably be there in the next financial year.
Mr. Reddy, if one were to take FY27 as the base, where do you go from there in terms of growth? Because obviously now the base will have shifted in a dramatic fashion. You would have gone from 500 to 900 to 1350, right? Can you continue to grow at that clip? Is that the kind of traction you see? Because aero and nuclear is just about 13% of top line. So there is scope, but I'm trying to understand how you see it.
It's very clear the kind of roadmap we have. At least I don't want to talk about many years, but even if you look at the next 3 years, for example, we would be able to grow at the rate of 50% revenue growth for the next 3 years. I don't want to comment beyond fourth year, fifth year, and all. Things might be even better, but this is the kind of consistent growth we can see year-on-year basis.
You do that, so you go from 1350 to 2000 to 3000 crore in terms of top line. What is the mix? How does the revenue shape up? New energy versus...
It's going to be, the revenue mix would be, the clean energy would be about 50 to 60%,
okay.
50% plus. And then we would have the nuclear division and the aerospace kicking in a lot of percentages there. So defense would be another area which we are looking at more and more. So it's a combination of all the... See, we are into multiple segments. That's the advantage in which we are in. It's just not in one area. So we are building in oil and gas as well, which will also kick in year 2 and year 3 as well. So that's how we have built a clear plan over the next 3 years, how we need to grow based on the kind of forecast and order book we have and the kind of feedback also what we have from the customers as well.
And Capex, what's the plan with regard to that? Because, venturing into so many different arenas, is the Capex completely done? Will you scale up gradually? How does that play out?
We would scale up gradually. Like we have the Capex in place, but there are certain expansion plans for clean energy as well. Oil and gas, we're doing the expansion plans. So these will be in place over the next 1-2 years. So we are building our capacities based on the demand. So right now the situation is more on the clean energy side. It's more on our execution and the capacity levels what we have rather than the demand is a lot more. That's all I can say right now. So we're trying to catch up on that, ramp up our capabilities to achieve as much as possible over the next 3 years.
And would you say that a demand comes from government for you? What's the predominant customer cohort?
Mainly the nuclear is basically from the NPCL government orders, nuclear reactors, what we have. Obviously, the aerospace is all MNC customers that we are working with all over the world. So that's something which is very encouraging for us. We have done a lot of work on that. A lot of certifications have been done towards that. So that's where you'll be able to see much larger numbers moving forward because of the kind of work we have done in the past.
Mr. Reddy, thank you so much for coming in and speaking with us. And of course, it's a cracking Make in India story which is playing out right in front of us. Of course, viewers, that's a very solid set of numbers. But the stock of MTAR Tech trades at over 100 times earnings. So that's something also that you want to keep on your radar. But very, very strong commentary coming through. 50% growth for the next 3 years in terms of growth CAGR. Takes the top line to 3,000 crore. But when you're looking at the market cap, it's sitting at 9,000 crore at this point. So something to of course, keep in mind. But what we'll do is slip into another very short break. We'll continue conversation this time around with regard to all of the stocks which are moving in trade. Let's talk about those on the other side of this break. Stay with us.